Would you like to learn how to spot and trade a post-earnings trade setup and then use options for the trade itself? Hi, I'm Larry Gaines, Power Cycle Trading. In this video, I'm going to show you a setup for a post-earnings trade. So this is on Costco, and Costco had earnings that came out let's see, right here on the on October the 5th. Okay, so what happens is that you have what they call, or what we refer to as the expected move. It's what the option market is expecting the particular stock in question to move as far as the days to expiration. So this was October 5th, and then on the 6th was Friday, so it had 1 day to expiration. So the market was expecting or forecasting after earnings that just 1 day that Costco could move down basically 3%, plus or minus 3%. It was looking for a move to the downside of 162, so about $5 down or $5 up. So it went out and closed at 167. So the expected move for just 1 day until expiration was for it to move to 162 to the downside, or it could move to the upside by 5. But you can see that the next day earnings came out and it moved, it exceeded the expected move to the downside, which was right here of 162. So it exceeded that and actually closed down at 157. So this is basically a 2 standard deviation move down. So when you see a move post earnings, right after an earnings release, that tends to be 1.5 standard deviation or 2 standard deviations, it sets up for a high probability for a directional trade in the direction of the move. So in this situation, it closed down almost 2 standard deviations below the close based on that earnings announcement, which was negative to the market. So the expectation and the probability is for it to continue then in this situation trending lower. So it's a high probability setup for that. So a couple different things you can do. You can do a pairs trade where you short Costco and maybe buy SPY. You could do a bear call credit spread, or you could do a really cheap put spread. So here's one setup, a couple different setups that we established today. This was on Costco, 2 different setups that you could have done this morning on Costco, knowing statistically that there's a good probability for it to move lower. And then we're looking for a target here to about 153, 154, and then potentially down here to 151. So a real low risk trade setup here was to do a put debit spread. So this morning, before it really started going, knowing statistically that there's a high probability to go lower, one setup was to do the October 13th series. This is for Friday's expiration, the 155, 152.5 at 60 cents. Now that current trade is 107, so it's up $47 per option spread just within today. The other one was to go out a week further and do the same setup, but doing it with the October 20 series right here. So it'd be doing the 155, actually 153, $2 wide spread, 65 cents. And so now that's up, about 94.95. So these are trades that you can put on, and basically when you have such good momentum, you can take it off the same day in this situation. So this particular spread trade setup, 155, 152.5 at 60-cent debit, currently at 108. Might as well take a little profit there and then see what happens. But this is based on the statistics that when you have an earnings trade or an earnings release, which was here on the 5th on Costco, and it exceeded the expected move, or that 1 standard deviation move, which was 162, and it actually was like 2 standard deviations, the tendency is for it to continue, and in this situation continue lower. Okay, I hope that helps. I'll talk to you on the next video update.